Welcome to our session in finance, where we're going to look at what is called the cost of capital. The cost of capital. Others call it work. So you must understand that whenever you want to start or finance a project as a company, you require funds, and some of these funds will come from equity, others will come from debt, others will come from retained earnings. Collectively, we call this the cost of capital. In essence, the cost of capital is actually the compensation to the people who are giving us money for supplying financial support to the firm. So, for the investor or the lender, their return is called the required rate of return. The required rate of return. So, we can take a few the simple terms that we can classify this capital that will be injected in a business. This capital can take several forms, which within different characteristics and implications. So the main form of capital that we're going to talk about is common stock or equity. So equity for common stock is simply a capital that is contributed by ordinary shareholders who are the owners of the business. We also have what is called preferred stock. Preferred stock is simply a hybrid kind of capital which carries a fixed dividend obligation, but it doesn't confer any ownership rights. So that is also debt. We also have what we call debt capital, which comes from the loans. So debt capital is simply borrowed funds from the lenders or financial institutions that require interest payments. And we, lastly but not the least, have what we call the retained earnings. These are profits that are reinvested into the business rather than distributing them as dividends. So each type of these kinds of capital has an associated cost with it. So we call them the cost of capital. So collectively, we come up with what we call the weighted average cost of capital. So we, in the introduction class, discussed to say each type of capital is associated with a cost. And these are in tandem with the roles that a manager has. We have decisions of financing, investment decisions, dividend decisions. Now here, we are going to combine two decisions, the financing decisions and the investment decisions. Are we together? So the main aim of a firm is basically to ensure that there's maximum gain. So why is cost of capital important? To value the maximization of wealth for a firm, to enable decisions for capital budgeting and other cost decisions. So we're going to start with the first cost, which is called the cost of debt. The cost of debt. So when talking about the cost of debt, what are we looking at? Cost of debt represents the borrowed capital. It is a cost with interest payable to the lenders because this interest is tax deductible. It is tax deductible. So companies will benefit from what is called a tax shield. A tax shield. So the tax shield, it reduces the after tax cost of debt. And the formula is given by the cost of debt after tax should be equal to the AD, which is the cost of debt before tax, times our 1 minus T. 1 minus T is called the tax shield. So this is the formula we'll be using. So the tax shield lowers the overall cost of debt because we know as a company under corporate tax, we are charged again. So to avoid double taxation, so we get to come up with a reduction. We remove that shield so that you don't pay double. So that is how we calculate the value of cost of debt. So KD after tax is equal to KD for tax 1 minus tax shield. So this one is very easy to calculate. So we have an example here. Suppose the cost of debt is 10%. A tax rate is 40% for the company. What is the after tax cost of debt. So the after tax cost of debt is before tax cost of debt is KD. We're given as what? 10%. So you put your 10. Then our 1 minus the tax percentage, so 1 minus 40%, so 1 minus 0.4. So meaning instead of paying 10%, you're going to pay 6%. So you have reduced the cost of debt from 10% to 6%. So this is the major advantage of using debt financing. This is one of the advantages of using debt financing. So there are many advantages of using debt financing. So the first one, we've just seen it here as being what? It reduces our amount payable to avoid double taxation. Okay, what other advantages do we know of debt capital? Number two, when you are going to engage in debt capital, you're not going to dilute the ownership of a company. So it means that those that you're going to borrow from, of course, it'll be stressful, but you still remain intact. The other advantage of having debt capital is that you have predictable payments. So debt comes with fixed payments. So you're able to know that, okay, I'm going to pay for budgeting purposes. The other important part of debt capital is that since you have debt obligations to be met regardless of the performance, companies will operate efficiently to control the costs. So there's discipline. All right. So it is also lower in terms of cost compared to equity because debt usually has cheaper than equity because lenders will bear less risk than equity investors. So this is an advantage. So we also go to another kind of structure which we call the preferred stock. Preferred stock. So preference shares are a hybrid form of equity. They have a partial debt and equity form. Okay, so they act like debt. So like dividends are not tax deductible. So the formula for a dividend is given by DP over PO, where DP is simply the dividend paid and PO is the market price. So we will have an example here where we're told that suppose we have a dividend paid of 11.7 kwacha, which is selling for 100 kwacha per value. Calculate the cost of equity. So if this is our um, dividend paid, so we're going to divide the 11.70 over the price of 100. So we're going to get 11.7%. So it is simply here, the dividend paid is 11.7, then divide by the price. Sometimes the question will not be this direct. In most cases, you need to calculate your dividend paid. So you may be given a par value and you're told that it's an 8% what? 8% it's an 8% preferential shareholder loan. So I'm trying to break down each of these ones because collectively we're going to calculate how work is done. So this is preferred stock. Then we go to equity. Equity talks about the shareholder. Okay, when talking about equity, what are we talking about? We're talking about the capital that is supplied by the ordinary shareholder. So these are the actual owners of a business. Any questions so far? Any questions so far?
So far it's clear. I just need to relook at the formulas.
So if that is clear, the formulas will come through. So we're looking at equity now. So when talking about equity, we're actually talking about the representation of capital contributed by the ordinary shareholders. These are the real owners of the business. So it requires a return. So we have two kinds of returns that these ordinary shareholders get. There's what we call capital gain, which is simply share price appreciation, and dividends. So now the dividends are the ones we're going to calculate using two popular methods. There's what we call the CAPM model, which is a capital asset pricing model, and we have what is called the Gordon's model or dividend growth model. So these ones are the two models that we use when you're dealing with the equity. So the CAPM model is simply given by the risk-free rate plus expected market return minus risk-free times beta. Okay, whereas the Gordon's model, we have the cost of equity, which is equal to D1, so dividend paid in year one, over PO, the price of stock now plus the growth. So these are the two methods we're going to use. So now we'll give an example to calculate each of these ones. So we're told that suppose we have a risk-free rate of 8%, so RF is 8%, an expected market return of 14%, so ERM is 14%, and the beta is 0.7. So remember our formula is what? Cost of equity is equal to what? Risk-free rate plus beta, then expected market return minus risk-free. So now this collectively is called the risk premium. Sometimes if you're not given the expected market return, they'll just say we're given the risk premium, you put it in here. So the risk-free rate is 8%, which we put there. The expected market return is 14%, and minus the risk-free rate, which are usually treasury bills, 8% times the beta, which is 0.7. So when you put this, we are going to get 12.2%. So this is our cost of equity using Gordon's model. You can also use our, this is called the CAPM model, sorry. You can also use the Gordon's model, which is given by D1, P0, 1 plus growth. So suppose the dividend in year one was paid to be 1.43, and with a growth rate of 6.6%, and stock is selling for $25. What is the cost of equity? So D1 there, you put here 1.40 over the current price of stock, which is 25.54 plus the percentage, which is 6.6%. We're still getting what? 12.2% on both of them. So this is how we calculate the cost of stock using any of these models. Now, we learned in our previous class that sometimes if you're given D0, you can use this to calculate our D1. Our D1 is equal to what? D0, 1 plus growth. So in this case, since our D0, if we're given maybe as 1 point, that's D0, you put it here, 1 plus growth, the growth rate is 6.6%. This will help you to calculate your dividend for year one. So before we go any further, we can do some examples. Are you there?
Yes, I'm here. Now I'm settled.
Okay. So let us look at questions on each of them so that we apply what we have learned. Calculating the cost of debt, the cost of equity, and the cost of what? Prepared stock. So number one, here's a question. Suppose a company borrows 500,000 at an interest of 12% per annum. The corporate tax is 35%. What is the after-tax cost of debt? So after-tax cost of debt, remember we said it's KD is equal to, this is after cost of debt before tax, 1 is tax yield. So we have our cost of debt, which is 12%. Then 1 minus what? 5%. So some of the figures are there to confuse you. We're not using the 500,000 anyway. So how do you get there?
It's giving me 7.8.
Yes, 7.8. So meaning your cost of debt has reduced from what? From 12% to 7.8
From
because of the tax
12%.
shield. Then we go here. ABC Limited pays a fixed dividend of 8 kwacha per share, and shares are currently trading at 80 kwacha each. What is the cost of preferred stock? The cost of preferred stock is simply what? Dividend paid over what? Over price of stock now times 100. So how much dividend was paid? 8 kwacha. So the 8 kwacha there.
8 kwacha.
Then what is the current selling price? 80 kwacha then.
80 kwacha.
So you divide that by 100. What do you get?
Multiply by 100.
Yeah, multiply by 100, yes.
It's giving me 10.
10% is your cost of equity, as simple as that. And here,
Okay.
a listed Zambian bank on the stock exchange has a beta of 1.2, risk-free rate of 7%, expected return of 13%. Using the CAPM model, calculate the cost of equity. So cost of equity we said is what? Risk-free rate plus beta, then risk-free rate minus what? Oh, expected market return minus risk-free rate. So here we have what? Risk-free rate was what? 7%. Then beta was how much? 1.2. Then expected market return 18%.
13%.
Minus a risk-free rate again of what? 7%. Okay. So what do you get here when you compute that?
Okay, sorry, I made a mistake. Let me just. Are we
So
Sorry, are we
given the
dividing here? Oh, that's a
7%,
percentage. Sorry, I think that's where I was confused. I was thinking it's a division aspect.
1.2 times this is what? 5.
That's a plus. That's a plus sign.
Yes. Just multiply 6 times 1.2. 1.2. That's
It's
7.2.
giving me 14.2.
Yes, 14.2 as the final answer.
Yes.
Okay.
So the formula is KE
Which
is
is
equal to R
RF risk-free rate
plus B
beta plus ERM expected market return.
Okay, let me just write these as I was not taking them down. Expected market return. Okay.
Yeah. Okay. So is that clear? The
Yes,
next
this is clear.
Okay, using the Gordon's using the other formula now.
Okay.
So we are done with them in parts. Then we go to the Gordon's formula here now. So it's show that shares currently selling for 20 kwacha. The company is expected to pay a dividend of 2.5 next year. And what? The dividends are. So using Gordon's model, remember Gordon's model is given by KE is equal to what?
DI,
D1
D1, sorry,
over
divided by PO, plus, I think I plus G.
Yes. So dividend, when you hear that they paid next year, so this is our D1. Okay. Then selling price, this is P0. And also growth rate, this is our G. So here we're going to have 2.50 over 20 plus 0.05. So what we get? 0.125 as 0.05.
We get 0.175.
0.175. Same as what? 17.5%. Okay. So now, there comes a time now where all this information, either way, I said if you're not given D1, you will be given D0, which you calculate. Okay. Any questions so far?
So far it's clear, but they don't come like this.
Well, they do. That's why I wanted to show you. They come a little tough because I wanted you to see firstly from the lessons perspective, so that you now get to see from the exam's perspective. Okay, they come like this. So I'm going to look at the question from the exam paper that has to do with work. Then we screen out the information that is there. Is that okay? But let me finish
Yes,
that
it's
part
okay.
remaining. So now I've talked about the capital structure to say the capital structure talks about where money emanates. Okay, comes in different denominations, which we call the capital structure. So now capital structure simply talks about composition of all these monies. So when a company is given a target of a capital structure, it uses different forms, a bit of equity, a bit of debt, you can't be over leveraged, everything over debt. So work is given by weight of equity times cost of equity plus weight of preferred stock times cost of preferred stock times weight of debt times cost of debt times the tax shield. So each form has a weight attached. So look at an example. For instance, we have a capital structure. Company Z has the following balance sheet. So debt here is 3 million, preferred stock 1 million, common stock 6 million. The total is 10 million. So what is the weight of each of these ones? So 3 million over 10 million is 30. So we divide. 1 million over 10 million times 100 is 10%. 6 million over 10 million times 100 is 60%. So total should be 100%. So this is just a composition of each. Then you are told that suppose the company has the following costs. The cost of debt is 10%. The cost of preferred stock is 12%. And the cost of tax is 40%. And the cost of equity is 12.2%. What is the weighted average cost of capital? So using work, we said work is what? Work is given by cost of what? Cost of equity times the weight attached. Okay. Plus cost of prepared stock times what? Weight of prepared stock. Plus cost of debt times weight of debt. Debt we know has a tax shield, 1 minus tax. So in this case, what was the cost of equity? The given cost of equity here was 12.2%. So you put 12.2%. But the weight, we calculated ourselves as 60% here, 60. And we go to the next one. Cost of prepared stock is 10%. Oh, cost of prepared stock is not the 10%. Cost of prepared stock is what? 4%. 4%. But the weight, aggregated weight for the prepared stock was 10%. So 0.10. One must be percentage, one must be 0.6 here. Plus cost of debt is what? 10%. 10%. And what was the weight of debt? 30%, 0.3. But also there's a tax shield here. Tax shield is how much percentage? 40%. So 1 minus 0.4. So if you compute this very well, you're going to find your weighted average cost of capital as 10.32. So this is how we calculate our weighted cost of capital. So you first get the weights, then you compute them. Now sometimes the weights are not given. You need to compute them on your own. Okay, so hope we're together so far. I don't want to lose anyone. Okay, so with that being said, let's try lead us through what do we do. For instance, we're given a question like this one here. Can somebody help if we're given a question like this one here, XYZ, as the following capital structure? And the costs are given as follows. So what do we do? Find the weights. How do you find the weights? How do you find the weights? Anyone? Are we here? The weights are just you total up the sum, then you aggregate, find the proportions.
You divide by the fraction, you add all of them, and then you divide each by their fraction.
Okay, elaborate. What do you mean? What? Simplify what you're saying. It's correct, but yeah, using advanced language. You first do what?
No, I mean you add the total values, then you get a fraction of each over the total figure.
So we add these ones. So this is 4 plus 2 is what? 6. 6 plus 6 is what? 12. So our total here is what? 12 million. Then we find the weight of each of them. What is the weight of debt? 4 over 12 times 100. What do we get? The weight here is 4 over 12. Hmm? 6 over 12, I know is 0.5. 2 over 12 and 6 over 12. What do we get? So 4 over 12 is 0. What? 33. 2 over 12. 0.117. The total should add up to what? 1. Then the only one that has a tax shield is what? The debt. If you multiply by the tax shield 1 minus tax. Tax is what? 30%. So 1 minus 0.3. So how do we calculate work? Work is what? Cost of equity and weight of equity plus cost of what? Cost of preferred stock times weight of preferred stock plus cost of what? Cost of debt times weight of debt. Except the debt has a tax shield, which is what? 1 minus tax. So are we together so far? What was the cost of equity? We've been given the cost here. Cost of equity is what? 14%. And what is the weight of equity? 0.5. And what is the cost of preferred stock? 11%. What was the weight? 0.17. What was the cost of debt? 10%. What was the weight of debt? 0.33. And what was the tax shield? 1 minus 0.3. Then you aggregate. Are we together so far?
Yes.
Okay. So if that is the case, you can proceed to how the exam questions look like. So since I've taught you how each of these ones are broken down, so they'll give you a balance sheet, something like that. You become confused all of a sudden. Okay. Let's look at question number 2 of last year's paper. So here we're given this question here. Okay. So what are we given there? We're given a balance sheet and we're given the costs to calculate. So we're being asked to find work, 25 marks. So in this case, you're just being trained to now understand Gordon's method, find each of these ones. So let's break it down. You do what you're able to manage. So the current liabilities are given by follows. Its common stock is given by this one. And this is that. So let's break down. What can you see from that information? Let's identify what you're able to see. Just tell me what you're able to identify. What is our current price? What is the growth rate? Let's identify everything in this. Are you there?
We're here.
So what do we
Tax rate is available.
Mm-hmm.
It's at 50%.
Okay, I need to attempt that as a classwork. for now, because you're not participating. Now you're waiting for your solutions. I'll give you a guide of what is needed. So we'll end here and continue the other part in the other class.